Hello, welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management, and my co-host today is Jeff Watkinson of Watkinson Capital Advisors, municipal bonds specialists. And then we'll also have as a guest today Jim Hemphill, who is CFP and principal at TGS Financial Advisors. Hello, Jeff. How you doing?
I'm doing well, Mike. How about yourself?
Doing great, thank you. So you know bonds, you know muni bonds. And obviously, we're in this environment over the last 2 years where interest rates have been going crazy, just going up from essentially nothing, negative, to mortgage rates at 8% today. What's going on? What's going on with the muni bond market?
Good question, Mike. I can't answer that question in a vacuum. Everything has to be relative. And so I need to set the table a little, what municipal bonds and interest rates are doing here in 2023. I'm sure you've heard in the investment business, famous quotes by Warren Buffett. And the one that resonates in my mind is, be greedy when others are fearful and be fearful when others are greedy. And we have to really go back to the low interest rate environment we saw post the financial crisis through 2021. And in 2021, investors were very greedy, driving prices up, yields down. About 3 years ago, the 10-year Treasury was 80 basis points. Now we're up near a 480 level, 4.8% on a 10-year Treasury. And municipal bonds don't move lockstep with treasuries. There's a relative ratio they gauge and they correct and self-correct. But
And do you think that, just a quick question on that? So the greedy part, was there a lot of investor demand, or was that mostly government demand, buying up their own bonds and monetizing debt? Or was it just a combination of the two that kept the rates down?
It was a combination of the two. But what I know in the municipal market was that there's 70% of the market is controlled by individual investors, mom and pop, either directly through buying individual bonds or indirectly through buying mutual funds and ETFs. And in 2021, when you had to go out 10, 11, 12 years to get a 1% nominal yield on a AAA rated California bond, people could not buy enough municipal bonds.
Okay.
$2 billion a week flowed into mutual funds. Classic buy high, low yields. And then obviously in the beginning of 2022, the Fed said, we need to raise rates to combat this inflation. There was record selling in 2022, which occurred in the 7th month of the year.
After everything already sold off.
Exactly. And the sell-off continued throughout 2022. There was a rally in the beginning of 2023. So last year we were saying to people who were looking at municipal bonds, these are the highest yields in the last 15 years. The market strengthened in the first half of 2023. The last 2 months in municipal bond land, the market's been weak. And when I say weak, that means if you bought a municipal bond in August, it was less expensive in September. And it's only human nature. I mean, everyone wants to buy at the bottom. And yields were extremely attractive in August. They've only become more attractive in September.
Right.
They've only become more attractive in October. So these are good credits. It's not a credit issue, but we've seen these interest rates go up and there's fear. And 70%, like I said, 70% of the market is controlled by individuals. This herd can turn on a dime. And
has it turned back to net buying now, or is it still aggressive
No.
selling, or was it
no,
imbalance?
it's still selling. There's still outflows. We are seeing, just to give you a level, again, relative, there's people in the municipal bond industry who've been in the business for 30, 40, 50 years. They told me in 2022, I never thought I'd see a 4% coupon bond muni trade at a discount.
Right.
And here we are in
Meaning
2023.
the interest rates are higher than 4%. So anybody that bought that bond is underwater now as far as the value of it, because you can buy a new bond at 4.5 or 5.
Exactly. And now we're
Right.
seeing investment grade 5% coupons trading at par, fives at par, which would have been unheard of 2 years ago in 20.
Right. I think this is also really interesting what you're talking about, because I think for our guest today, with their model, their dynamic contrarian portfolio strategy really is fine. I'd like to know more, but my understanding, my belief is it sort of takes advantage of that you don't have, the market doesn't, just because it looks hot, isn't that's maybe not the market you want to be in. And maybe in fact, you want to be taking some of the weight off of that market, get into something that's not performing, quite so well. So you're essentially fading the crowd, which is very difficult to do
Fading the crowd. What a great way to
emotionally.
put it.
Yeah.
I looked over our guest's slides and he had Dow bar statistics, which we can talk about.
Oh, those might have been mine last week.
That might have been yours. Okay.
Yeah, okay.
And the whole idea is the average
I,
investor underperforms due to behavioral. And I found, especially with equities, stocks, and in my research in the municipal bond industry, I found a couple of years ago that municipal bond investors are even more skittish than equity investors, which I found shocking.
hmm,
But it's a unique asset class where 70% is owned by mom and pop. There's not a lot of institutional money compared to other asset classes.
and is it because of the tax benefit, the state tax benefits of owning the munis, that it's more of individual rather than institutional owned? And is it more high net worth then because of the tax bracket and the benefit of owning the municipals?
Absolutely. I mean, people buy municipal bonds for their safety. It's the second safest asset class behind US Treasuries, and they buy it for the tax exempt income.
Okay.
And there's banks that, banks and insurance companies kind of fill out the remaining 30%. But traditionally, it's around 70% owned directly and indirectly by people who want to get a better yield than a CD at the bank, a money market, a treasury, and
Okay.
they tend to be in the higher tax brackets.
And my guess is you could almost argue that it's the safest asset class since the U.S. government lost one of its A's, at least with Fitch's and I guess Moody's. It's double A instead of triple A now. So if you can find a triple A municipal bond, technically it should be a higher quality than the U.S. government, according to those rating agencies.
That's true. 3 A's are bigger than 2 A's.
Yeah, whether you believe it or not. Okay, so we do have a question here today, Jeff, from Dan Jenkins in Philadelphia. What are some tips for buying bonds today?
Dan, that's a great question. And I was thinking about this question earlier today. And I think the number one most important thing is know your purpose for this capital. And align your bond and align the maturity with that purpose. For example, I don't want to be in the stock market right now. I want to park cash. You might look at a treasury bill or a money market. You have a 12-year-old daughter. She wants to go to college in 6 years. Okay, I would pick a bond with a 6-year maturity for that first tuition check. Really understand your maturity and line that up. And I would also, it's kind of a loaded question. I would also work with a specialist because they're going to remind you, or they're going to ask you, they're going to discover your purpose for this capital. And if there's volatility in the bond market, which there will be, they will remind you, hey, you bought this bond for your daughter's college tuition.
Stay the course on it.
You bought this bond for the income. You will get your money back in 10 years. Relax. Stay the
Okay.
course. I mean, those are my two biggest tips.
I appreciate it. Thank you, Jeff. And Money Matters TV does take audience questions. If you are interested, here's how to send in your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, matters, M-A-T-T-E-R-S, TV.com.
Welcome back. Thank you. I'd now like to introduce today's guest. It's Jim Hemphill of TGS Financial Advisors. Hello, Jim.
Hey guys, good to see you, Mike. Good to see you again after a couple of years.
Yeah, it's been a little while. We haven't hung out at all, so
Yep.
we'll do it here, and then we'll have to do it again.
Sounds great.
So tell me a little about your advisory practice.
So we started in 1990. We're based in Radnor, Pennsylvania. We work with about 250 client families. We are a large, small firm, small, medium-sized firm. We started off as almost entirely an investment practice, and over time, the planning aspect of the practice has become more and more important. So that at this point, I would say half our work is planning and half is the investment research and trading.
Okay. So you talked a little about your typical customers there, and now the research, the trading side. I think you have a process called dynamic contrarian portfolio strategy. Why that name, and how does it relate to how you manage investments?
So our typical client is a successful family who are looking at retirement, looking at accumulating money for retirement. So we're a retail practice more than an institutional practice. And so our first mandate is not to let anybody lose money permanently, if that makes sense, or to have a degree of loss that prevents them from supporting themselves in retirement. So we start with a very broadly diversified portfolio, different asset classes, mostly mutual funds and exchange traded funds. We pay a huge amount of attention to cost. The one thing you know for sure is if you pay 2% instead of 0.25%, you're 1 3/4% behind just out of the box, even before you get to the question of performance. The contrarian part is we do tilt toward, on the equity side, we do tilt toward value stocks. I'm a believer in the proposition that in the long run, for very classic economic reasons, value is likely to outperform growth by 2 to 3% a year. Now, you can't prove that by the 10 years through the end of 21 for sure, or so far this year. The dynamic part is that we have a baseline portfolio, but we tilt away from the baseline portfolio when paired price indices, for example, growth versus value or large versus small, or paired yield comparisons, the S&P 500 versus the 10-year Treasury bill, when those relationships go significantly out of historical channels or historical relationships, then we will intentionally flow money toward the assets that are cheaper, that we believe to be cheaper. And then we're pretty stubborn about maintaining those positions, even if we get difficult markets, as sometimes we do.
And when you're saying you're skewing it one way or another, what kind of allocations are you changing percentage-wise? Is it substantial, or is it just sort of tweaking at the edges?
That's a really good question. So the pricing or yield relationship anomaly has to be pretty significant, a standard deviation or more, before we will change at all. And we really don't change a lot unless you get to 2 standard deviations or above. In other words, if this wasn't finance, if this was mathematics or physics, something you would see very, very infrequently. But Mike, I think you and I have seen 5 sigma events a dozen times in the last 20 years. So clearly something is going on with human behavior that exacerbates market movements.
It's amazing how many 30-year events we've had in the last 50
correct.
years.
I'll give you one example. In in 2007, we were about 50 at moderate risk, which is classic 60-40 portfolio. We were about 57% stocks, and the rest bonds, real estate securities, and cash. In March of 09, we were 72% stocks. And, and you look at that and say, gosh, how did these guys know when the market was going to bottom out? And the answer, of course, is we didn't. But what we were looking at is that relationship between the dividend yield in the S&P 500 and the yield in treasuries. And since 1953, for more than my entire lifetime, treasuries were yielding more than common stocks. And in March of 09, common stocks were yielding more. So we just flowed money in that direction. Now, that's, I think, the absolute single perfect best example of when the strategy works.
Right.
And of course, it doesn't work like that all the time.
Jim, I got a question for you. When we hit these 2 standard deviation moves in these relationships, this is rules-based. You're not,
Yep.
there's no like, oh, maybe we'll wait another week. It's a rules-based decision to start flowing to the other asset class.
That is right. And there are, so the example that I gave was the time when the confidence that that was the right rule was just super high. And we just, again, we bought things, we bought stocks and they went down. We bought stocks and they went down. We bought stocks and they went down. But when the market bottomed, we were well positioned. But the rules-based aspect of it, and that really just is such a good question. There are times when that has put us in positions that have not been profitable. And we recently brought back our former managing partner who's been in venture capital land to do some really basic research on the shape, the amount of abnormal distribution or kurtosis in the curves of the asset classes that we look at. And what we're trying to do with that is to improve the basis of the rules. Because the problem with the rules-based system is if you have the underlying reality correct, you know what you're going to do, and you just have to have the courage to do it. But if the rule is imperfect, and I think all rules at some point are imperfect, yeah, you could be in a position, inevitably at some points will be in a position that is suboptimal.
Jim, very interesting. So give me a little color about like the marketplace out there. I mean, Vanguard has this star fund, which, and then on the other side of the spectrum, there might be strategies like yours for pension funds, more institutional type money. How does your strategy fit in this mix?
That's probably a good way of looking at it, because first of all, we love Vanguard. Vanguard is an ethical, well-managed, low-cost producer of financial products, financial merchandise, financial vehicles. The Star Fund, for example, is a fund of funds. It is a fund of, I believe it's 5 different Vanguard mutual funds. So compared to the Star Fund, we are more broadly diversified. We are more tilted toward value, and we have a larger international component. Compared to institutions, again, this gets back to our clientele. We have human beings who have finite lifespans, whereas the University of Pennsylvania Endowment literally has a theoretically infinite lifespan. So they would own, in many cases, assets that are not liquid, private equity, hedge funds, non-tradable real estate securities, private loans, just a whole spectrum of assets. Everything that we own can be marketed every single day the market is open and trading is occurring. So that's a difference between us and the institution. So we're kind of halfway, I would say, between a Star Fund, which is a good vehicle that we have used with kids and grandkids of clients with small amounts of money for years and years, and the terribly sophisticated, but also in many cases terribly illiquid strategies that are followed by institutions with multi-billion-dollar budgets.
But, as far as the money size, what size portfolio do you need to manage in the dynamic contrarian strategy?
That's a good question. Our sweet spot is individuals, families in really a $2 to $10 million category. We have folks that are below that. I would say you really need 500 minimum to make a portfolio as diversified as what we're running advantageous. For someone who has $100,000, for example, in a 401k, you're probably going to be a lot better off if you just choose 3 or 4 funds rather than the more complicated strategy. What the portfolio is good for is folks who are delegators, who want to have something that is well managed, that tilts toward capital preservation, and just not have to worry about it.
Right.
That's what we think we do well.
Okay. Now you don't sound like you're not active managers, but you have a systematic process, something that gives you some belief that things are skewed in your favor to shift assets a little bit. So, what are your thoughts on the passive versus active debate that's out there when it comes to asset allocation? Is there a reason to use one at sometimes and the other at other times?
We have gotten more and more passive in our choices within our active allocation categories over time. And the reason is, if you think about it, in 1999 was the crucial issue whether you bought the Kinetics Fund or the Janus Growth Fund. No, the key question was whether you were or were not betting everything you had on tech. So we believe that the crucial decisions are at the asset allocation, asset class level, and that within the asset classes themselves, we want vehicles that are representative of that asset class, that are consistent and that are tax efficient and really inexpensive. Now, that's mostly true. We're doing a lot of work right now in the small cap growth space, where historically we haven't had much money, and a lot of work in the foreign large cap growth space. We've used in the latter, we've used an ETF, the iShares, just Morgan Stanley Growth ETF, and based on research that we've been doing, it just looks like that index is a pretty lousy index, and it's clear that it holds a lot of really lousy stocks.
Wow.
So what we're thinking of is, what we're planning to do at this point is to make a transition from an index investment to an active managed portfolio in that foreign growth space, with a more concentrated portfolio.
That's interesting, Jim. Very interesting. You said earlier that you combine financial planning with your research and your dynamic contrarian portfolio strategy. When you do risk tolerances, when a client comes in, they're 60 years old and they want to retire in 5 years, how do you work with your strategy and developing a different asset allocation strategy for that whole spectrum on the risk tolerance variance, I guess?
Yeah, that's a really great question. The industry for years and years has had these super complicated risk management or risk tolerance questionnaires, investment policy statements, and what we've learned is folks are really, really bad at understanding their own risk tolerance. And when you were speaking before about this cycle of emotion, when markets are really high, everybody is super confident. No, I want to swing for the fences. I'm a sophisticated investor. I'm willing to take the risk. And then that same person, is on the phone on March the 6th of 2009 saying, no, I have to get out of everything because obviously this is going to zero. So we do a guided conversation. Part of it is just taking a history of someone's past investment behavior, and have you ever sold out? Is that something that you've done at some point in the past? And if so, I think that speaks to a lower risk tolerance. The best way to put it, I think, is you want to own as much stock as you possibly can that you are going to be willing to hold on to during the worst market that we can imagine.
I like that. I like that.
We're liable to get a worse market than that at some point.
Yeah. Yeah, it seems like you always end up with something worse than you thought you could possibly get. It does happen that way. So you gave an example of the financial crisis and increasing to 70, something percent in the equity exposure. Do you have any other examples like that? Something more recent? When didn't it work? When did it?
Exactly. That's what I was going to say. So getting back to Jeff's question about, is it a rule-based system? So we were underweight growth and tech starting in I'm going to say 18.
Mhm.
And so that was an incredible run by what that we used to call the FANGs, right? But now nobody wants to say the name Netflix anymore. So now we call them the Magnificent Seven, the 7 tech stocks. And during that run, when they went from 16% of the S&P to 26 or 27%, we were way underweight. So during that period, we underperformed because that was a growth in tech market. And if you weren't chasing growth in tech, you were just underperforming. And we thought those stocks were too expensive. Then in 22, last year, it sure looked like they were too expensive. And then through the middle of this year, oh my gosh, we were off to the races again.
How are your clients handling that? Have they, I don't want to say trained, I guess I just said it, but do you have them conditioned to be able to ride through that underperforming period, and when they're hearing from their friends making all this money on Tesla stock or Apple and something that you're underweighted in?
We have not had that problem. I think it's not so much that our clients are trained as that our clients are well matched. We're a good firm for folks who want to take care of their money, who want to follow good practice, and who very often look at some of the new money, some of the tech stuff, and say, gosh, I don't think this is going to end well. So we have remarkably few calls about people who are worried about underperforming because they don't know they don't own tech.
That's great. That shows you're doing your job.
Sounds like you're doing a lot of the work on the front end to
I think
set their
so.
expectations, right?
That's a good way of putting it. And also just there are people who come in who say, where they clearly want to double their money. Just guys, by the way, if you can hear, I got some dogs to provide music in the background, which you may or may not be able to hear. Expectations determine behavior to a large extent, and those people whose expectations are more reasonable, I think, are just a better match.
Well, Jim, I appreciate everything. I think that was a great conversation. I'm real fascinated by what you're doing. I think it makes so much logical sense, and the systematic approach certainly resonates with me as well. Keeping the emotions out, I think, is so important, and it sounds like you've been able to do that both in your model and how you run your firm, as well as how you educate and continue to engage with your clients. But I appreciate your time here on the show today. Thank you.
Mike, thank you so much.
You're welcome.
And Jeff as well.
Thank you.
You too, Jim. Nice being on there with you. Thanks so much.
Thank you. So our next guest on Money Matters TV is Judy Wilkins-Smith of System Dynamics. Thank you for watching Money Matters TV, where your money matters. See you next time.